Hello, Business 500D students. This is Professor Hassey. It's our final examination introduction video, and I'm apologize for the last couple of weeks. I have had a variety of illnesses in my family, and I've had to travel back and forth to Detroit, Michigan, to take care of things. I'm the eldest son in the family, so I'm in charge, and I've had to accept some of those responsibilities. But with this final examination, we're covering exactly what we needed to cover for this course to get you prepared for finance in your MBA program. And this final examination is in two parts. The first part is the subject of this video tonight. Today is Monday, July 25th, and it's covering the capital budget analysis. In the second video, which will be posted on Wednesday, July 27th, that will be a video explaining the second part, financial statement analysis. So here we are in our course presently, and we're going to concentrate tonight on two main file folders. The final examination file folder, which will be due July 31st, but there are extensions available to August 2nd if you need extra time. It's the final examination I give you a template to do your spreadsheet analysis on, and it gives the examination in both a Word and PDF format. And then our subject for tomorrow night, the second part of the financial statement analysis. If you go to week 8, here is a sample of the spreadsheet, which we'll be going through in this video this evening. And then we'll be picking it up with the financial analysis spreadsheet tomorrow, or on Wednesday. So that's where we stand, and we have a lot of material to cover this week, and we will. And if you need extra time, I will be happy to give you extra time for the examination. So our first step is capital budget analysis, which is chapters 9, 10, and 11 of the text, and some very important work about determining the return on an investment. We go out and we raise capital through the issuance of bonds or stocks, and then we go out and take that capital and invest in an asset. Is that asset going to be proved economically viable for the amount of money that we're borrowing or issuing equity? And that's what the capital budget analysis. Every company in the world who purchase assets for return on investment goes through this exercise. So it's a key part of your MBA finance study. So let's take a look at that video, and then we'll go walk through again one more time the final examination for the capital budgeting part for tonight. Okay, here's that spreadsheet. Now, if you want to download this file and follow along with me through the video, that is a good way of doing this. If not, you can just see how I does this. And once we're done with this, I will repost this file with the correct answers in one tab so you can see how we did this. So again, this is the capital budgeting process where we determine an asset investment with a depreciable life. The depreciable life will determine the life of that investment. We have to determine the cash flow generated by that investment to determine net income, operating revenues and expenses, taxes, and net cash flow, taking into account depreciation, working capital, and salvage value, all determining the net cash flow being generated off the asset. Then once we have that net cash flow, we compare that asset investment in year 0 to the return analysis, net present value, internal rate of return, profitability index, and payback. 4 key ways of determining return off an investment. And then once we determine that, then we compare that analysis to various risks. Risk based on level of output or units produced, risk based on the sensitivity or the change in certain key variables and how that affects profitability or return. This is what case 2 is about, and this is a core concept of corporate finance. And many of you probably, especially if you had me before, have studied this in other finance classes, but if you have not, you need to have this under your belt as part of your MBA program. It's a key. So let's take a look at this analysis. The first thing we have to do is we have to determine what is the cost of capital of this investment. In other words, what 3.78 plus 5.2, that's 8.98%. That's our total cost of capital based on the current market conditions and the current makeup of their balance sheet, capital structure. That's the risk in the market of this company, and that's what it costs them, 8.98%. That's our discount rate to be used in our return analysis, the cost of capital. Then we look at the base analysis here. This is for a 10-year project. They're investing $1 million over 10 years with a salvage value at the end of 10 years of $50,000, with a depreciation per year of $100,000. They anticipate selling 25,000 units per year over the 10 years at a selling price of $2. Their inflation rate after year one for the selling price is 2.5%. It's costing them $8 a unit variable cost to produce it. That's changing at an inflation rate of 2% every year. Their fixed costs are $50,000 per year, and that's changing at an annual inflation rate of 1%. We've already determined that their WACC, or their weighted average cost of capital, was 8.89%. I believe that was what it was. Oh, 8.98%, excuse me. 8.98%. That's their cost of capital. We've just determined that. We know the company's tax rate in this context is 30%, and they have a working capital cost of 12% a year of their next year's sales. We'll talk about that as we go through this. Your job in this base analysis is to determine the cash flows being generated by this investment of $1 million over 10 years. And then take that cash flow and discount it and determine the return in dollars, the return in a percent, the return in a ratio, and the return in time. And that's called a base case capital budget cash flow analysis. Once we're done with that, then we're going to determine what is called a risk analysis, determining scenarios at different probabilities and unit sales and changes in key variables by plus or minus various deviations of percent. And that's in this screen. Oh, hang on here. And we'll do that risk analysis. Just a sec. Get that out of there. And there's this risk analysis here that we'll be putting together in this tab. All right. And this is what you have to do in case number 2. Not for the meek now. This is MBA study and number crunching at its best. So we've already determined that our cost of money is 8.9%. Now let's determine our cash flows. First of all, we know the investment in year 0 today is $1 million. $1 million. Notice I have some preset formats here with the formulas. You do not have this luxury in your case 2, though I do give you the template set up. You have to put in the formulas and calculations. So investment of $1 million is going to generate a salvage value at the end of its life of $50,000. So at the end of year 10, the last year of the project, they're going to get $50,000 of additional money by disposing of this investment. Now they're going to fully depreciate the asset over its life at $100,000 a year. Matter of fact, let's put that in right now. So there's the 100,000 depreciation. Notice what happened when I put in that 100,000. It automatically calculated my EBT and my net income, but I still have a lot more numbers to put in. But also it put that 100,000 down here back as positive cash flow, adding back in that depreciation, because depreciation, as you know, is a non-cash expense. So we add it back in. So we now know that we're fully depreciating. Whoops, I forgot this one number here. I can't forget year one. There we go. So we're fully depreciating $1 million or $100,000 a year. So that $50,000 salvage value in year 10 is going to be capital gain. So we have to take tax on it. So we'll put in a formula here saying $50,000 our salvage value is going to be multiplied times 1 minus our tax rate, 0.3. In other words, we have to pay 30% tax on that $50,000. We get to keep the rest. We get to keep 70% of 50,000. That's $35,000. So that's additional cash flow coming into this investment with the disposal of the asset at the end of its depreciable life. Why do companies do that? Even though they might fully own that asset for longer periods of time, the IRS allows you to sell and dispose of that asset at the end of its depreciable life when you no longer can depreciate it anymore. It no longer becomes a tax advantage after you fully depreciate it. So that if you dispose of it, you get some additional cash flow after taxes in that final year. So we're selling 25,000 units a year at $20 a piece. That's the assumption used in this analysis. So if we go to year one and type in 25,000 units times 20 bucks, there's our first year revenue of $500,000. And notice what my spreadsheet format here did automatically. It incorporates the 2.5% inflation rate every year after year one. So we're building in inflation. Matter of fact, that's pretty low inflation compared to what's going on in the world right now. But in other words, we're going to increase the selling price after year one by an inflation rate of 2.5%. We're still going to sell 25,000 units every year, but we're building that inflation into our analysis. And notice over the course of 10 years, it grows quite nicely to a total return or total sales of a little bit over $5.6 million. So that's the revenue anticipated being generated off this $1 million investment. Another interesting thing to note after we do this revenue, and that's the working capital. Working capital is additional capital that you need to run your asset during the life of the asset. It could be setup costs. It could be additional receivables or inventories you have to fund. You'll eventually get all this money back, but it's additional in dollars that you spend during the life of the asset. And notice the working capital rate. It says here it's 12% of next year's sales. So in year zero, I take 12% of 500,000. That's an additional $60,000 of cash I need to have available to fund the setup of this investment asset. So as you can see now in year zero, my total investment today is $1,060,000. And then as my revenue changes every year by the inflation rate, I have additional working capital costs because those sales change over the course of the life of the asset. And here's how I do it. For year one working capital, this is net operating working capital. I take the delta in this formula between year two sales and year one, which is $12,500. And then I multiply that $12,500 by 12%. So that means I have to allocate an additional $1,500 cash of additional cash to run the asset during year one. If you notice, the total of 60 and 1,500 is $61,500. If you take 12% of 12,500, that's $61,500. We're maintaining the 12% base of next year's sales throughout. Another way of looking at working capital is if any of you ever bought an automobile and you paid for the asset, let's say you paid $40,000 for a car, Is that the end of your expenses to monitor that car? No. The rest of those expenses are insurance, registration, maintenance. That's all additional investment that you make into that car. That's called working capital. In the case of an asset that's generating revenue, which your car probably is not, you get that money back over time, but you still have to allocate those cash flows out to maintain your automobile, to maintain that asset over its life. And that's what this represents. But notice what happens at the end of the project's life in year 10. There's no additional years. The project is over. So what I do in the final year now is take 12% of the final year's sale, 624, 431, and I get $74,932. If I take from year 0 to year 10 and add those all up, I get 0. It's a wash. It ends up being $0 expended in this analysis. But we're properly showing dollars going out in the early years, and then all those dollars coming back when the project is over, and the working capital can be refunded back to the business as positive cash flow. Now let's look at our variable costs. We're producing 25,000 units a year at $8 a unit. So we type in year 1, variable cost, 25,000 units produced, times the $8 cost, we get $200,000. And notice, due to the miracle of spreadsheets, it's now increasing that by the inflation rate of 2% every year. Remember, sales was 2.5. There it is right there. Variable costs are 2%. 2% increase by inflation over the life of the variable cost. And then we get to fixed costs. Remember, fixed costs are just a flat dollar amount, no per unit. So in the year 1, our fixed costs are $50,000. But also fixed costs do increase, and in this case, they increase 1% every year. And there's the fixed costs increasing at 1%. So notice right now, our spreadsheet is complete. We've determined our revenues, our expenses. We now take that earnings before taxes, the total here of revenue minus expenses, and take 30% of that. That's our tax rate. Subtract that, and now we get our net accounting income generated off this investment of $100,000, revenues, expenses, and taxes. So we're making $1.322 million in net accounting income off this investment. But that's not our project cash flow. Our project cash flow is taking into account the working capital, the depreciation add back, the salvage value in year 10, and the working capital being balanced out at the end of its life. And adding and subtracting those from net income, we get $2.417 million of projected net project cash flow. Pretty good. So an investment of $1,060,000 is generating over the 10 years into the future, $2.4 million. But what does this mean today in year 0? We're spending the money today. How can we correlate this future flow to what we're spending today? And that's what these 4 numbers are telling us. Remember, the net present value is taking the discounted cash flow and comparing it to the investment. Well, what's the discounted cash flow? It's this flow of cash, $2.4 million, discounted back at 8.98%, our cost of capital that we determined earlier. So if we put that into a formula, equals formula, function, net present value. This is the function key in our spreadsheet, very handy. The net present value with our interest rate is our cost of capital of 8.98%. We determine that. And our values are year 1 through year 10 cash flows. In this case, F21 to O21, I'm taking the cash flows for every year, and now I'm going to discount them back at 8.98% in this function. I get 1,500,092. Pretty cool. So my net present value is the difference between the discounted cash flow and the investment, 440,092. That's my discounted cash flow net present value. Pretty good. It's a profit. So we're returning in today's dollars $440,092. That's a return analysis number 1. Return analysis number 2 is the internal rate of return. What is this $440,092 in a percent? Formula, function, internal rate of return, IRR. And all we do here is paste the values of year 0 to year 10. Year 0, column E to year 10, and it's going to automatically calculate 17.03%. So on an investment of $1 million, we're generating 17.03% return on our investment. That's compared to a cost of 8.98. That's a good thing. Our profitability relationship is a ratio of the discounted cash flow to the net cash flow. What is that relationship? All right. Well, we put that in there as discounted cash flow divided by negative net cash flow. We want to make that a positive. And we get a ratio of 1.42. In other words, if you want over 1, so we're getting a ratio of 1.42 times greater than 1 of our investment. It's a ratio. And then now we do, and I'm going to get rid of this so I can show you how this is done. Now, how long did it take us to get this 1,060,000 back in dollars? It's called a payback. So in year 1, we have an investment of a 1,060,000, and we generated $203,500 of return. So at the end of year 1, we still have $856,500 to pay back of the investment. Then in year 2, that $856,500 is going to be reduced by the cash flow of year 2. We're down to $647,438. And now that we have that formula there, we can now just slide it over. And notice at the end of year 5, we've built up a positive return of $14,730. So it took us 1, 2, 3, 4, and part of year 5 to pay it back. How much of a part of year 5? Easy. We now just take the percentage of how much was left to recoup at the end of year 4 and divide that by our year 5 return, and we get 94%. 1, 2, 3, 4.94 years. And that's our payback period. 1, 2, 3, 4, and then 94%. It took us 94% of year 5 to pay back to the 1,060,000. So it took us a little bit under 5 years to pay back the 1,060,000 in strict cash payments or return. So there's our risk analysis. Our capital base analysis. we've now determined that an investment of $1 million with these variables is going to generate a dollar return of $440,092 and percentage return of a little bit over 17%, a ratio return of 1.42 to 1, and pay back the money in a little bit less than half the time, 4.94 years. That's our base case analysis. Now what we'll do next is determine, okay, this is what we think is going to happen right here. So that's all we need to know for our final examination for the first question. In that final examination question, we are given the cost of capital, or the WACC, 9%, so we don't have to calculate that out. And then we're given all these following details about the capital budget analysis. Remember the example we just did, and that was a prior video of another class. So when it said case 2, it meant final examination. So I apologize for that, but I kind of used that older video to explain some of this. So in that sample video, it was 10 years. This is 5 years. That's why I give you the sample or the worksheet to do your work on for this exam, and I'll show you that in a minute. So you get these variables, you put them into your spreadsheet, and you do the calculations that we just did. And once you do that spreadsheet and complete it, your only final determination is based on the information you find, will you give this project a go or a no-go? And that's the first question. The second question, financial statement analysis, we'll handle that in our video on Wednesday, July 27th. So here's that template that I gave you with your final examination work, where I have all the variables there, and now you have to put it in to this analysis. Determine the net project cash flow, and then do the return analysis. That's what you need to do. And now notice there's no formulas here whatsoever. So you're going to have to put in the totals, the calculations, and all the formulas, but we just practiced that in the video this evening, and that should give you a good analysis and where to start and do this section. The bottom line is to determine the net project cash flow, and then do these analysis, these 4 numbers, and then tell me whether this is a go or a no-go project. That's question 1 of the final. Okay, so that's the first section of our final examination for this Business 500D class. You are to fill in this template. That's all the work you need to do for the first question, is fill out that template, that spreadsheet, and then post it to the final examination file folder. That's question 1. Question 2 is a financial statement analysis of one of the companies in your portfolio, and we'll talk about that in our next video. All right, everybody, have a great rest of the week. This will give you a head start on the final. If you have any questions, please email me, post them to the discussion forum. Be happy to answer them. Until next time, we'll see you later. Bye-bye.